think about bond markets at a very high level, what we're doing is saying, how much do I want to get paid to lend you money for a certain amount of time? Well, what if it's risk-free? Risk-free means I'm going to get my money back with certainty. The value of that investment might move around quite a bit. I should have disabled this little thing. The value of that investment might move around quite a bit, but I'm going to get my money back when it's all done. When we think about treasuries, that's really what we're talking about. How much do you get paid for knowing you'll get your money back after a year, 5 years, 10 years? The answer right now is not very much. But bond markets are also about saying, well, what if you don't get paid? What are the odds that you don't get paid, and how much do you get back if you do? And so we price that risk around. But we don't pay attention to it. We don't think about all the different borrowers and lenders in the market, and there are trillions of them. We can jump ahead here just to give you an idea. The bond market is bigger than the stock market. And this is just in the US. Once you start going outside the US, often the bond markets are even bigger. The reason it's so big is that every single person out there, every company, every small business, every real estate, mortgages, everything, it all gets lumped in here. This is huge. And this is critical to people being able to go about their businesses, their lives. If you want to take out a mortgage, whether you know it or not, you're tapping into the bond markets. If you want to go to a bank or a company wants to go to the bank, you're tapping into the bond market. And actually, the bond market doesn't even include all of that. But this is a big deal. So when the Fed takes rates to zero, what they're really doing is saying, anyone who wants to borrow, it's not going to cost very much. And then they just want to make sure that the markets are working, that you don't panic too much about people being able to repay back. So bond markets actually end up driving stock markets. Again, we'll talk about why that is the case. Greg, I don't know if you have some questions here.
Well, you know what it is, Tim? That's the point here. The bond market seems to be lumped together. I know there's a slide we have there that really shows it isn't just the treasuries, but it's a world. And part of that world is, by this slide here, is you're seeing there's areas like corporate notes, which are debt issued by companies, and then there's treasury, which is debt issued by the U.S. government. How about just quickly, just sort of high level, that it isn't just a treasury or a CD market. There's a whole family of fixed income out there that, without having expert knowledge on and expertise in that area, where you kind of are just relying on other folks. So can you maybe walk through this and just discuss what are the options out there? Because people are sitting there for years going, I'm so tired of getting zero. I'm getting zero at the bank. The CDs are getting me next to zero. So the holy grail, right? How can I get better yield, better return, but not put myself at risk like the stock market apparently feels like to me?
Right. Well, some of the answer is that there's no free lunch. If you want to get paid, you have to take risk. But not all risk is the same. There are different kinds of risk. So there's stock market risk, where things are going to go up and down. They could go down for years at a time. Maybe the company's prospects are terrible and you're never going to get your money back. Or there's the bond market, where you have a lot of different kinds of bonds out there. So we got this little colorful chart to highlight it. These are some major asset classes within the bond markets. You can see at the bottom the dispersion in returns between the best performing and the worst performing in a given year is just massive. It's much bigger and more in terms of the difference than you would ever find in the stock market, because there's more difference between these types of securities. You talk about corporate bonds. That's the, IBM or Amazon decides they're going to go and borrow a bunch of money for 5 years, 10 years, 30 years, just like the US government. And people are willing to lend them. They're going to demand more than they will from the US Treasury. And how much more, it just depends on how much appetite there is for making that kind of loan and that kind of risk. In general, you earn more in yield than you do you always earn more in yield than you will from treasuries when you invest in these. You take a little more risk too, nothing like equity risk, and over time you outperform treasuries. In fact, the performance difference for taking a little bit more risk is really significant. There are some asset classes in here. You notice what is leading the charge in a lot of different years is high yield. Well, high yield is just debt from riskier companies. I've met with some of the largest pension fund managers in the world, and it's interesting how they'll start to be like, oh, I really don't like high yield. It seems very risky to me right now. we're putting a lot more money in equities. And I scratch my head and make the comment to them, well, you know that these are the same companies that you own in your equity sleeve. And they just sort of don't make the connection because people think, well, a high yield company is a company that can default. Well, the thing is, what we're facing right now in the US and around the world is the idea that, yeah, there are going to be companies that default. There are going to be individuals who can't make payments. But it's not going to be a complete wipeout where every company defaults, in part because the Fed stepped in and Congress stepped in and said, hey, this isn't anyone's fault right now. We want to make sure that you companies out there, that when we do get to return to normal, you're still left standing. So the important services you provide are still available and the jobs that you provide are still there. In the meantime, for investors who want to continue to lend them money, along with the Fed or whoever else, you get paid extra. So how do you earn more than the zero you're getting with CDs or with a money market fund or with short dated treasuries? You take a little bit of credit risk. And it can seem really uncertain, but it's actually a way to say, I'll get paid some extra, but with a really high level of confidence that in 1 year, 2 years, 3 years, I'm getting my money back and then some.